Hi CS students, let's revise CFA and AFM Chapter 5 Security Valuation. Practical question 7. Capital structure of Sun Limited as at 31st March 2023 was as under. So the equity share capital 80 lakhs, 8% preference share capital 40 lakhs, 12% debentures 64 lakhs and reserves 32 lakhs. Sun Limited earns a profit of 32 lakhs annually on an average before deduction of income tax, which works out to be 35% and interest on debentures. Normal return on equity shares of companies similarly placed is 9.6% provided profit after tax covers fixed interest and fixed dividend at least 3 times and capital gearing ratio being 0.75. Yield on share is calculated at 50% of profits distributed and at 5% on undistributed profits. Sun Limited has been regularly paying equity dividend of 88%. Compute the value per share of the company assuming 1% for every one time of difference for interest and fixed coverage fixed dividend coverage and 2% for every one time of difference for capital gearing. Okay, now going to the problem. First we need to calculate this profit after tax coverage and then capital gearing ratio, then this yield on share, then compare it with the similarly placed company's share, then we need to find out the value per share. Okay, now going here, the first requirement, which is profit after tax and fixed interest coverage with the fixed dividends, we need to find out the profit after tax. So they have given Sun Limited earns a profit of 32 lakhs, so which will be profit before interest and taxes, so which we have mentioned here, and then the interest is 12 percentage debentures. So 64 lakhs into 12 percentage, we are getting 7.68 lakhs. If you reduce it from profit before tax, before interest and tax, we'll get profit before taxes 24.32. On that, taxes 35 percentage. If you reduce, then the profit after tax will be 15.808, which is 15 lakhs 80,800. Then preference dividend will be reduced 3 lakh 20,000, which is nothing but 40 lakhs into 8 percentage. Then going further, 12.608 will be the earnings available for equity shareholders. Then from that, equity dividend of uh, 6 lakh 40,000 will be deducted, which is nothing but 80 lakhs of equity shares into 8 percentage which the company is paying. Now the retained earnings, which the undistributed profits will be 6 lakh 20,800. Now this is the income statement. Now using this, we'll go further to the each requirement. Now the first one, profit after tax coverage, fixed interest and fixed dividend. Now this is nothing but interest and fixed dividend coverage ratio. So the ideal ratio will be EBIT divided by debenture interest plus preference dividend divided by 1 minus tax rate. But the similarly placed companies requirements are to be compared, so hence our formula will be profit after tax plus debenture interest divided by debenture interest plus preference dividend. So what is this formula? Profit after tax plus debenture interest will be the earnings after tax along with interest tax benefits. And what it is covering? It is covering the debenture interest and preference dividend which the company is paying right now. So when we check, the profit after tax is coming around 15 lakh 80,800 along with the debenture interest 7 lakh 68. So this will be my earnings with the debenture tax benefit. and divided by 10,88,000 which the company is paying as the cost. So if, as we can see, it is 2.1588 times, which signifies the company is earning 2.15 times more to cover the fixed interest and the dividend coverage ratio, dividends. So the company is paying 10 lakh 88, but it is earning 23 lakh 48 800. So it can cover up to 2.15 times of the debenture interest and preference dividend. ICAI has given a net of tax also. There is another solution, but here what my thought is, ICA is taking this approach wherein for our previous cash flows finding, we will find out the tax benefit on the uh, profits, right? Like profit before tax before depreciation, wherein we'll reduce the depreciation, then from there we'll reduce the taxes, we'll get profit after tax, again we'll add the depreciation to get the cash flows. Or the other approach will be the profit before taxes and depreciation, then we will we reduce taxes directly from here, and then we will add uh, depreciation multiplied by tax rate to get the benefit on depreciation. Same case here, EBIT minus interest, then EBT minus taxes, wherein profit after tax, then with this profit after tax again we are adding the interest portion, so that only the tax benefit on interest portion gets added. So earnings after tax before depreciation, that is what is considered as the coverage here. Now going further, the second requirement, capital gearing ratio, fixed interest bearing funds divided by equity shareholders funds. This will be the formula. Now fixed interest bearing funds will be the preference share capital plus debentures divided by equity shareholders fund, nothing but equity share capital and reserves. So 104 divided by 112 will gives us 0.92 times as the capital gearing ratio. Now the yield on share, so they have calculated 50 percentage of profit distributed and 5 percentage on undistributed profits. 50 percentage of profit distributed is nothing but whatever profit is distributed is 6 lakh 40,000, which is the equity dividend, multiplied by 50 percentage, and undistributed profit is nothing but 6 lakh 20,800 multiplied by 5 percentage, and the yield on equity shares is 3,51,040. Now the yield divided by our equity share capital will give us the percentage on yield, which is 4.388 percentage. Now they have given value per share assuming the 1 percentage every time, 1 percentage for every one time of difference for interest and fixed coverage, and 2 percentage for one time of difference of capital gearing ratio. So we have to find out the value per equity using these approaches. So first, 1 percentage for every one time of difference for interest and fixed coverage ratio. We know that interest and fixed dividend coverage ratio of ours is 2.16, and the industry standard is 3. So 3 minus 2.16 will give us 0.84, multiplied by 1 percentage will get 0.84 percentage. Now same case goes with 2 percentage for every difference. So whatever difference we are getting, we have to multiply with it with the percentages. In the second case also, capital gearing ratio, one time difference we have to get two multiplied with the two time difference. So our the industry standard is 0.75 and our numbers are 0.93. So difference is 2%, 0.18, which is multiplied with the 2 percentage, we are getting 0.36. Now the normal return expected is 9.6 based on the similarly placed companies, and the differential which we got compared to the normal return on similarly placed companies, in case of interest coverage is 0.84, which we found out previously, and in case of capital gearing is 0.36. Giving adjustment to those factors, our expected yield will be 10.8 percentage. So so the value per equity share will be nothing but actual yield divided by expected yield multiplied by paid up value of share. So in our case, paid up share value of share is 100. So 100, and the actual yield which we got is 4.388. So we can take 4.39, and the expected yield which we calculated is 10.8, which is nothing but the normal return expected around the similarly placed company is 9.6, and we have given effect to this risk premiums, which is nothing but 1% for every one time difference of interest and fixed dividend coverage, and 2% for every one time difference for capital gearing. So after adjusting this, we are getting a 10.8 expected yield, which is the correct 10.8 is the expected yield. Now 4.39 divided by 10.8 into 100, we are getting 40.65. This will be the value per equity share. Thank you.